Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it. And basically we are covering the types of banks, right? And we had covered 5 types of banks till now. Okay. Starting from the commercial banks. Okay. Second, from cooperative banks. Okay. Third, from regional rural banks. Okay. Fourth, from payment banks. And the latest one which we had covered so far is the small finance bank. Okay. And since the last lecture or last few lectures, we are covering the discussion over the foreign banks. Okay. Starting with the establishment. All right. Starting with the approval of the license. Thereafter, we had covered the minimum capital adequacy. We had also seen an interesting Basel 3 framework. Right? It's Basel. Basel 3 frameworks and not all. Okay. So basically now we are going to continue with the same bank and we will cover the more and more related facts regarding this. Okay. And we will try to end these types of banks in this lecture. All right. So this lecture is going to be very, very important because now we are going to ending the series of the types of banks. All right. So please pay your attention and please revise the series once we're done. All right. With this note, let's start this lecture. So right now, we are going to cover the cross-border transaction provision of the foreign banks. Okay. So let's start with the general introduction or the basic definition you can call it. Okay. So the cross-border transactions are financial activities that involve the movement of funds or assets across international borders. Okay. Foreign banks operating in India are allowed to engage in various cross-border transactions, but these activities are closely regulated by the Reserve Bank of India to maintain stability in the foreign exchange market and ensure the compliance with the Foreign Exchange Management Act regulations. All right. So if we try it to break down this particular paragraph into the main points, then what we have noticed? We have noticed the 3 points. What is the first point? Cross-border transaction means transactions occurs across the border. Okay, like suppose if you are sitting in India, your friend is sitting in USA or Australia or Europe, you can say. Okay, so it means that you both are sitting in a different borders. You are sitting in an Indian border, someone sitting in the European border or the American border, right? So if you are doing some kind of transaction, like you have paying something, okay, he's paying you something. So this is the cross-border transaction, right? Because the transaction involves the money transfer across the border from USA to India or maybe India to USA. Okay, so this is the cross-border transaction. Is the first thing we had noticed. Second thing which we had noticed is that foreign banks are allowed to participate in cross-border transaction. Okay, it means that suppose, just take an example. This is the USA. This is you in India. Okay, your friend lives here. You lives here. Someday you got a call from your friend that your friend needs a urgent need of $1,000. Okay, which is in Indian currency stands nearly about 80,000. Okay, please remember this amount is an approx amount. I'm not saying that this will be the accurate account. Okay, it's an approx because the exchange rate is fluctuate continuously. So I cannot predict that this will be the exact amount we will get after conversion of the USD into rupees. But I'm just estimating it that the $1,000 might be 80,000 rupees. Okay, so this is your friend asked you to help him. Okay, so if you want to transfer this money, what you will do? Will you pack some pigeon and then tie the money with his leg and then fly him over this ocean? Won't, right? So what you will do? What you are going to do? You will use the banking services. And when you will use the banking services, there are two types of banks you will get. The first is the domestic bank. Second is the foreign bank. All right. Like if you are using a domestic bank, then might be it will be the SBI, it will be the HDFC, it will be the ICICI, whatever bank it could be. And when you are using the foreign banks, then it might be a HSBC bank. Okay. Might be the Citibank. Okay. Might be the WeWork. Okay. Might be the Tide Bank. So whatever bank it could be. There is no particular limit that the bank would be this one. Okay. So now what you have noticed and what I have told you, I had told you that when you are trying to transfer the money from you to your friend, you are getting two options, domestic banks as well as foreign banks, right? It means that the foreign banks could also facilitate the cross-border transaction. Similar thing, suppose if you are needing 80,000, then your friend could send the $1,000 to you. Okay. For this, he will ask your account number and IFSC code. So you can give the account number of domestic bank as well as the foreign bank. But the condition is that you must have an account in it. All right. Like you say him, okay, transfer the money into the HSBC account, but you don't have any HSBC account. Okay. So it's a complete ridiculous thing. All right. So remember, the foreign banks are also allowed to take part in the cross-border transaction. Here comes the third point, which is the important one. Third point states that Reserve Bank of India closely monitors the foreign banks in foreign exchange or cross-border transaction. Okay. Why? Why? Because the first thing is that it is an ethical issue. Okay. It is important for our monetary policy, for economy. Also, we had a act, Foreign Exchange Management Act. For this, it is important. But apart from this, let me tell you one thing. Okay. Foreign banks, in the starting, I had told you, the foreign banks are not registered in India. They do not have their headquarters in India. They do not incorporate in India. Okay. So it is very, very easy for them to withdraw from India and go to their domestic country. But what if they had done something which is economically or lawfully is not in the favor of the country? Then we will have a limited options to take the action against them because they are not registered in India. They do not have any, you can say, domicile in India on a particular basis. All right. That's why the RBI has to ensure that those banks are being watched carefully by the agencies. All right. So I hope you have got the basic introduction. Now let's move forward. So the first is the trade finance. Okay. Trade is basically the buying and selling activities, right? That's what we had decided. Okay. So the foreign banks plays a crucial role in facilitating the international trade finance for businesses in India. This includes such as letters of credit, bank guarantees, and export-import finance. Okay. About these things, we will have a discussion in the upcoming lectures in the tidbits of the banking sector. Till then, just remember, this kind of services could be provided by the foreign banks. Okay. And this kind of services could be also provided by the domestic banks. All right. Trade finance ensure that the Indian businesses can engage in the international trade with confidence, knowing that their transactions are secure and compliant with international trade regulation. Okay. It means that suppose if you are the person and this is the person, you are sitting in India, this person is sitting in USA. Okay. You had bought a something from him. Okay. And let me tell you one thing. There might be a condition that the item will be on the cash on delivery or will not be on the cash on delivery. For first example, suppose you had paid rupees 10,000 to him for transportation of something. Okay. But if this is not doing by a regular channel or the legal channel, then it means that you will not have any records or documents to be authenticated that you had paid rupees 10,000 to him. What if this fellow received your money and didn't send anything to you? It means that you had become a victim of a fraud. Okay. But meanwhile, if in this transaction you had a bank XYZ, okay, it might be the foreign bank or might be the domestic bank, but you had the bank. Okay. It means that your transactions will be recorded from both the sides. It means that from the side of India as well as from the side of USA. So that in case of any adversity, you can claim easily. Got it? So that's why it ensured that the businesses can engage in the international trade with confidence, knowing that their transactions are secure and compliant with the international trade regulations. All right. Thereafter, second is the foreign exchange operations. Foreign banks in India can participate in the foreign exchange operations, including currency trading and hedging. They provide foreign exchange services to businesses, individuals, and other financial institutions. So basically, we can say foreign exchange means to change the currency one for currency two. Okay. Like you had given rupees 83 to get $1. Okay. So it's a currency exchange. And generally, it is doing for the, you can say, ease of living or shopping. Like you had went to USA, you belong to India, so that you will have a rupee, but the rupee is not applicable in USA, so that you have to convert it, right? So for this thing. But it is also used for the trading known as the currency trading. Okay. Suppose you had bought the US dollars when they were at the cheap price. Then you had sold them when they were at the high price. Okay. So this is an example of the currency trading. Okay. For this kind of transaction also, the foreign banks could be used. All right. These services enable clients to convert one currency into another. As I had given you the example that the dollar is being converted into the rupees. Similarly, the rupees is being converted into the dollars. All right. Manage currency risk and engage in international financial transactions. Cross-border investments. This is another important term. Foreign banks assist clients, including the institutional investors and the individuals, in making cross-border investment. This may involve portfolio investment, foreign direct investment, or participation in global financial market. Okay, so we can say there are two types of investment. First is the foreign portfolio investment. It is basically related with the purchasing shares or acquiring some stakes in a foreign country. Okay, like suppose this is you. You live in India and there is a company in the USA called XYZ. Okay, you know that the XYZ is going in the profitable way and you want to buy the shares or the stake. So for this purpose, you could use your bank called ABC. You will provide the money to the ABC. ABC will purchase a share for you. Okay. Similar thing will be this. ABC, when you ask the ABC to sell out your shares, ABC will sell out your shares and the money will be given to you. So this is called the foreign portfolio investment. It means that you are just purchasing shares or acquiring some stakes in a foreign company. Whereas FDI means foreign direct investment means when you are establishing or investing in a manufacturing unit or factory. This is called the foreign direct investment. Okay, suppose this is you. You live in India. Okay, and thereafter you have seen that the Vladivostok, which is a city in the Russia, okay, they have a very good opportunities for the foreign businessmen. So that's why you decided that you will open your plant there or you will establish your factory there. Okay, so you had made the transaction of rupees 100 crores in the Russia or the Vladivostok for the establishment of your factory, right? So this transaction could be done by the use of bank called ABC or whatever. All right. This is called the foreign direct investment. Means you are not only buying the shares and stakes, but you are establishing a proper plant or machinery or making the proper investment. Okay. So for this kind of services, we could use the foreign banks. Foreign banks offer investment advisory services, help clients navigate regulatory requirements in foreign banks, and provide access to the global investment opportunities. Okay, it means that not only they facilitate your transactions, but also give you the advice. Suppose this is you. This is your bank called ABC. And this is the reason where you want to make the investment. Vladivostok, Russia. Okay. So you are having rupees 100 crores. But you are not sure that whether you should make the investment of 100 crores or not. Because it's a huge amount, right? And you do not have a proper knowledge about the reason. You have just come to know about by some research paper and by some magazine. Okay. So what should be done in this case? In this case, you could reach the ABC. The ABC will give you the financial advisor, okay, who will, on behalf of you, examine the conditions of the Vladivostok, explore the Vladivostok, prepare a proper sheet for opportunities and for threats, okay, and this sheet will be shared with you so that you can examine the opportunities or the possible threats by yourself. And then you can decide that whether you should make the 100 crores investment or not. Okay. So this is called the advisory services. Okay. And for this, the bank charge some money. Okay. Because he will not provide you the advisor on the free basis. Okay. Thereafter, regulatory oversight by the Reserve Bank of India. RBI closely regulates the cross-border transactions, as we had already learned in the first part, okay, to ensure that they are conducted in compliance with the FAMA, which stands for the Foreign Exchange Management Act 1999. Right? FEMA is the primary legislation governing foreign exchange transaction in India. Okay. Basically, it was introduced in the year of 1999. Okay. To govern all the transactions are being done across the border. Okay. For the enhancement of the security and the safety of Indian financial market as well as India's national security. Okay. So that we could manage that the money could not be used by the terrorism or the anti-state elements. All right. That's why whenever the foreign banks or any other banks. But right now, because we are talking about a particular foreign banks, then we will consider only the foreign banks. Okay. So whenever the foreign banks are being indulged in any kind of foreign transactions, thereafter the RBI regulates and monitors them as per the provisions provided or enumerated in the FEMA 1999. Okay. And why the foreign banks get a little bit special treatment than the domestic banks? Because the foreign banks are those banks which have not been incorporated or registered in India. It means that they could be easily leave the Indian country. Okay. And if we are not vigilant at the time of the transaction, then we could not claim them in later. All right. Because we have to do a very, very, very long procedure for the international norms and rules and regulations. That's why the Reserve Bank of India try to put the foreign banks on surveillance with a special category because they are not incorporated in India and they could leave the country easily. Okay. And to ensure that whether they are doing the things on the right way or not. If they are not doing the things, then this could be corrected immediately on the spot. All right. So that is the provision of the regulatory oversight. Okay. So now let's move forward. Foreign banks must adhere to the FEMA guidelines related to the capital transactions, current account transactions, and the other aspects of the cross-border activities. Okay. Capital account and the current account transaction. FEMA basically categorize the cross-border transactions into the main types like the capital account transactions and the current account transactions. All right. Okay. So now the question is, what do you mean by the capital account transactions and the current account transaction? So basically, what do you mean by the capital? This is the first question which should arise in our mind. What do you mean by the capital? I had already told you a lot of time. Okay. So I'm expecting the answer from your side. You have 15 seconds. Your time starts now. It's 1, it's 2, it's 3, it's 4, it's 5, it's 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Time's up. So the S capital basically means any asset keeping by an individual or an organization is known as your capital. Okay. It might be cash. It might be the land. It might be plant and machinery. Okay. It might be the human power, which is known as the human capital. Okay. So any kind of asset holding by the particular organization is known as the capital. Okay. So now comes to the capital account. So basically it was defined under the Section 2 of the FEMA Act. Which section? Section 2 of the FEMA Act. And what do you mean by the capital account? So basically, capital account transaction is that transaction which involves creation or violation of assets or liabilities. Okay. Capital account transaction is that transaction which involves a creation or a violation of a asset or liability. Okay, like you had purchased a land in Australia. So the land is the asset. Okay. Similarly, you had bought a plant and machinery in Germany. This is the capital. Okay. Or the asset, you can say. So the transaction is being done by acquiring these things. It will be known as the capital account transaction, but for the asset creation. Okay. Similarly, for liability creation, suppose you had taken a loan from the, you can say, British bank for 20,000 euros. Okay. So this will be your liability because you have to repay this loan after some time. Okay. Similar thing is that suppose if you had rented a boat for your business transport, this is also known as the liability because you have to return this boat after some time. So all the transaction is being done for this kind of things by acquiring the land, by acquiring the plant and machineries, taking the loan from the British bank, renting a boat. All these are known as the capital account transaction. Why? Because they involve the creation and the evaluation of the assets or liabilities. All right. Second is the current account transaction. Current account transaction. So about it, we had already discussed that it means receiving or making of payments on a daily basis for mercantile purpose. Like you are buying and selling the things to your neighbors or the cross borders on a daily basis, and when you are making the payment of it. Okay, so this is known as the current account transactions. All right, so these are differentiated in the FEMA, and the provisions related with the controlling of this kind of transaction is also different as per their nature. Okay, so the capital account involve the significant financial movements such as the foreign direct investment and the investment in the foreign securities, because you are creating the asset or the liability on the foreign soil. Okay, these transactions are subject to the specific regulations and the reporting requirements. Okay, the RBI, suppose before this, let's suppose you had make the capital account transaction by using the ABC in the country of Australia. Okay, so the Reserve Bank of India, the Reserve Bank of India may ask the ABC to give the details about this transaction. Okay, like the details about the customer who had made the transaction. Thereafter, the details about the receiver to whom the transaction has been made. Okay, this should be disclosed with the regulatory authority. So we can say these transactions are subject to the specific regulations and the reporting requirements. Okay, we can say that there is a upper limit of making the cross-border transaction for individuals as well as for corporates during a certain period of time. Okay, thereafter, the current account transactions cover day-to-day international trade and the remittances. Like if you are buying and selling the things, you are making the payments on the regular basis. These comes under the capital account. Sorry, current accounts. Okay, such as import and export payments, travel-related expenses, and remittances by the individuals. FEMA regulations for current account transactions are more liberal, allowing for smoother cross-border trade and payments. Because these are happening on day-to-day basis, so if there will be a lot of rules and regulations being imposed on this kind of transaction, then it will become a harder and harder to pay the transactions across the border. Okay, so that's why the liberality and some kind of relaxations has been provided on the current accounts. Second is that they are in low denomination than the capital accounts. Why? Because the capital accounts are being done for the creation of the asset or liabilities, right? So they are being done for the investments and taking of the investment. So the transaction value is generally higher, all right? Whereas the current accounts are being made for the day-to-day purposes. Okay, so that's why the transaction values in the current accounts are smaller in comparison with the capital account. Clear? Thereafter, the provision for anti-money laundering, known as the AML, and know your customer KYC compliance. Okay, foreign banks are required to maintain the robust AML and KYC procedure when engaging in the cross-border transaction. This includes verifying the identities of the clients and conducting the due diligence to prevent money laundering and the terrorist financing. Okay, so for example, we can say this is the ABC. This is the one person who lives in the India. This is the second person who lives in any country of Middle East. For example, who lives in Somalia. Okay, this person has made a transaction to him for rupees 1 lakh. Okay, so the first case is that the anti-money laundering. Okay, it means that when the ABC will transfer the rupees 1 lakh to this person in the Somalia, the ABC will confirm each and every detail of the money, like from where the money has been come, all right, so that they could prevent the black money laundering. Okay, it means that the 1 lakh will be the black money with this person. He has sent this money to that person, okay, so that he could be safe in the Indian territory, all right, and after some time this money will come back to that person through the Hawala networks. About Hawalas, I had told you in the previous lectures. Second one is the know your customer. It means that before proceeding any kind of transaction or before participating in any kind of transaction with the person who lives in India, the ABC will try to complete the KYC. It means the ABC must have each and every detail regarding the customer they are handling with. Okay, what is the occupation, what is the PAN card, Aadhaar card, and other related documents. Okay, what is the full name, what is the father's name, mother name, what he is, and which country or city he's living right now, what is the phone number, email ID, all these things. Okay, so these are required. Thereafter, the reporting and the documentation. Foreign banks must maintain records and documentation of their cross-border transactions in accordance with the RBI and the FEMA regulations. Accurate and timely reporting helps them monitor foreign exchange flows and maintain stability in the foreign exchange market. So the first is the documentation. Like whatever the transaction has been made by them, they must keep the proper documents, like whom the transaction has been made, when, and what was the amount. All right. Second one is the reporting. It means that they has to report the Reserve Bank of India that during the certain period of time they had made this kind of transactions, that was the amount, and to whom and to which country these transactions were made. All right. Second thing is important, which is called the self-awareness. What is this? Suppose this is the person who lives in India. That is the bank called ABC, right? And that is the person who lives in, you can say, Lebanon. All right. So suppose that fellow had made a transaction to him for rupees 2 lakhs. Okay. While making the transaction, the ABC and the employees, or you can say the staff of ABC, got some suspicious thought that that money is going to be used in some wrong intention ways. Okay. In such a scenario, they could inform the RBI. Okay. So that the RBI could monitor the transaction by themselves or could inform the relevant authorities or the security agencies so that this kind of transaction could be checked on the immediate basis. All right. So the reporting and documentation is necessary. Reporting and disclosure requirements for foreign banks operating in India are essential components of the regulatory oversight. These requirements ensure transparency, accountability, and effective supervision by the Reserve Bank of India. Okay. They include the periodic reporting. Foreign banks are mandated to submit the periodic reportings to the Reserve Bank of India, which provide the comprehensive information about their operations in India. Okay. These reports are typically submitted on a regular basis, such as the monthly basis, quarterly, semi-annually, or annually, as per the instructions received from the Reserve Bank of India. All right. Okay. Thereafter, the financial performance report. Foreign banks are required to disclose their financial performance in India, includes details about their income, expenses, profit, and losses specific to their operations within the country. Okay. Like if they are operating in India and they state that their expenses and their income were 20,000 crores and 30,000 crores during a year, for example. Okay. In such a scenario, we can say it is the healthy situation. Why healthy situation? Because what they had invested, they had got more than it. Okay. But if this will be a reversible condition, which means expenses would be 30,000, income all will be 20,000 only. It means that this will be a bad condition because they had invested more, got loss. Okay. Second scenario is for the profit and losses. Okay. For healthy situation, the profit must be higher than the losses. Okay. So suppose if the profit was rupees 15,000 crores and the losses were for rupees 8,000 crores, it means the bank has a surplus profit for 7,000 crores. Okay. Even after adjusted the loss. Got it? So that's why the you can say reports or financial reports are requested by the Reserve Bank of India from the foreign banks on the regular basis. Okay. So that we could be able to figure out that what is the actual condition of the bank, or we can help them or also ensure the security of their stakeholders. All right. Thereafter, the financial performance reports enable the Reserve Bank of India to assess the bank's financial health and its ability to meet regulatory capital adequacy norms. All right. Suppose if the bank is already suffering the heavy losses. Okay. Because of the non-performing assets or other investment losses, but still they are making a rapid outstanding. It means still they are providing the loans, still they are making the investment. In such a scenario, they will not be able to meet their depositors' applications because they are expanding more, earning less, which means their financial stability is in the danger. Okay, that's why the Reserve Bank of India could increase or decrease the regulatory capital adequacy norms. Okay, so that their stability could be ensured and the impact of the stability on the economy could also be ensured. Thereafter, the risk exposures reporting. The foreign banks must report their risk exposures, including credit risk, market risk, operational risk, and the other material risk. About the types of risk, we had a discussion in the upcoming lectures. Okay, this information helps the RBI to gauge the bank's risk management practices and assess its resilience in the potential challenges. All right. Thereafter comes the compliance with regulatory norms. Okay. Reports must include details regarding the bank's compliance with the regulatory norms and the prudential requirements set by the Reserve Bank of India. This encompasses adherence to the capital adequacy standards, asset quality norms, liquidity management guidelines, and the corporate governance standards. Okay. Transparency and disclosure principles. It is very, very important so that the clear picture could become in front of people, could become in front of the regulatory authorities. Okay. Transparency is a fundamental principle of banking regulation and the supervision. Foreign banks are required to adhere to the transparency and disclosure principles to provide accurate and timely information to the Reserve Bank of India. Okay. Transparency ensures that the Reserve Bank of India has access to the critical data needed for effective supervision and monitoring of the foreign bank operations. As we had already discussed, suppose the expenditure was rupees 30,000 crores. All right. The revenue was only 15,000 crores. Okay. This is the actual situation. But because of the lack of transparency, the Reserve Bank of India is not getting the proper picture from them. Okay. It means that what is happening in the bank is not known to the authority. All right. And this is unethical as well as danger for the economy as well as the stakeholder and additional to it for the bank itself. Okay. That's why the transparency is must and ensures that the Reserve Bank of India has access to the critical data needed for effective supervision and the monitoring of the foreign banks operations. Okay. Thereafter, the timely submission, it is another principle. Foreign banks are expected to submit reports and disclosures in a timely manner specified by the Reserve Bank of India. Timelines crucial for the Reserve Bank of India to conduct effective oversight and make informed decisions. Okay. Audit and the financial statements. The financial report submitted by foreign banks should be based on the audited financial statement prepared in accordance with the Indian accounting standard, okay, or international finance reporting standard, whatever is being prescribed by the bank or permitted by the Reserve Bank of India. Okay. Supervisory assessment. The Reserve Bank of India uses the information provided through reporting and disclosure to conduct supervisory assessment of the foreign banks. These assessments evaluate the bank's overall financial stability, risk management practices, and compliance with the regulatory requirements. But this could only be able, or you can say, this could only be possible, not able, sorry. This could only be possible if the proper and accurate, transparent information is being conducted to the RBI. Okay. Second, on the timely basis. Okay. then only the supervisory assessment could be possible. Thereafter, the corrective actions and the penalties. If the RBI identifies deficiencies or irregularities in the foreign bank's report, it may take corrective actions or impose the penalties as deemed necessary to ensure the compliance with the regulatory standards, like the RBI does with the domestic banks. Okay. Thereafter, the confidentiality and the privacy. While transparency is critical, RBI also ensures the confidentiality and the privacy of the sensitive information provided by the foreign banks. Uses the data primarily for regulatory and supervisory purposes. It means that whatever the information is coming from the bank to the Reserve Bank of India, the Reserve Bank of India protects the information and the privacy of it. Okay, so that this information should not be leaked in the market and could be used in an adversary manner for the bank. Okay, the RBI actively supervises foreign banks to monitor their financial condition, risk management practices, and adherence to the regulatory requirements. RBI has authority to take corrective measures or impose penalties in case of the non-compliance or the financial instability to safeguard the interests of depositors and maintain the stability of the Indian banking system. Okay, so in summary of the foreign banks, we could say RBI plays a crucial role in regulating and overseeing the operations of the foreign banks in India. The regulatory framework ensures that the foreign banks operate within the boundaries of Indian banking laws and contribute to the overall stability and development of the Indian financial sector. Here we had finished the foreign banks. Now let's have a look on the other types of banks, which are just giving as for the definition in this lecture, because we are going to cover them in the other lecture in the depth form. So first we have the export and import banks. Remember, we are just looking at the definition right now because we have a separate lecture on them. Okay. So the Exim banks, such as the Export-Import Bank of India, specialize in financing and facilitating international trade, provide services like export and import, finance, export credit insurance, and the export promotion. It is a definition. All right. Second comes the NBFCs. About them also we have a separate lecture. NBFCs are financial institutions that offers various financial services, including lending, asset management, and investment. They complement traditional banking services and cater to specific financial needs. There comes the industrial banks. About them also we have a separate lecture. Industrial banks focus on providing financial services to large industries and corporations, offers services like project financing, working capital loans, and trade finance to support industrial growth. Development banks, like Industrial Development Bank of India, provide long-term financing for industrial and economic development projects. Okay. So students, basically in this lecture, we had completed with the types of banks. In the next lecture, we will start with another series under the banking awareness of the financial knowledge. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture and thank you.